Losing 50% of your account doesn't cost you 6 months. It costs you years. You'll never get back. You probably think recovery is symmetrical. You lose 20%, you make 20%, you're back. You lose half, you double, you're even. That's what it feels like it should be. But the math doesn't work that way. And this gap between what feels true and what is mathematically true is where most trading careers die. Not from a series of small mistakes. From one catastrophically large loss that resets everything. One trade where you risked too much. One position you held too long. One moment where you convinced yourself the rules didn't apply. And suddenly you're not recovering for a few weeks. You're recovering for years, if you recover at all. This isn't about discipline. It's not about emotional control. This is about understanding what a large loss actually does to your account and your timeline. Most traders think the problem with a big loss is the money, the dollar amount. But that's not the problem. Money is replaceable. You can add more capital. You can make it back. The real problem is time. Every major drawdown destroys months or years of compounding. It removes you from the exponential growth curve you were on and puts you back at the beginning. And compounding doesn't care about your feelings or your effort. It only cares about uninterrupted growth. One large loss is an interruption you might never recover from. Not because you can't make the money back, but because you can't make the time back. Here's the math you cannot argue with. If you lose 10% of your account, you need to make 11.1% to get back to break even. Annoying, but manageable. If you lose 20%, you need to make 25%. That's harder, but still achievable in a few months with a decent strategy. But if you lose 50%, you need to make 100% just to get back to where you were. 100%, you have to double what's left. If you started with 50,000 and you're down to 25,000, you need to turn that 25 into 50. And if your normal return is 3% per month, that's going to take you over 2 years. 2 years just to get back to break even. Not to make progress, not to grow, just to undo one mistake. Now add in the psychological cost. Those 2 years aren't going to be calm, confident trading. You're going to be grinding. You're going to be desperate. You're going to feel behind. Every losing trade will feel worse because you're already in a hole. Every winning trade will feel less satisfying because you're just clawing back to zero. You'll be tempted to size up to recover faster. And if you do that, you'll probably blow up completely. This is the hidden destruction of large losses. They don't just cost you money and time. They cost you your psychology, and once your psychology is damaged, your edge disappears. You stop executing your strategy properly. You start making emotional decisions, and those decisions create more losses. It's a spiral, and it starts with one bad trade you didn't manage correctly. Long-term capital management was run by some of the smartest people in finance, Nobel Prize winners, PhDs in mathematics and economics. They had sophisticated models. They understood risk better than almost anyone on the planet. And in 1998, they nearly collapsed the global financial system. They lost $4.6 billion in a matter of months. How? Leverage. They were leveraged 25 to 1. Their models were right most of the time. But when they were wrong, the position sizing amplified the loss to a catastrophic level. One bad bet sized too large destroyed years of gains and almost took down the entire fund. These were not stupid people. These were not reckless people. But they made one structural mistake. They allowed a single scenario to threaten everything. And that's all it takes. This happens because your brain doesn't process drawdown risk accurately. When you're up, when you're winning, your brain focuses on the potential upside. It downplays the downside. This is called optimism bias. You think you'll exit before the loss gets too big. You think you'll see it coming, but you won't. The market moves faster than your ability to react emotionally. And by the time you realize the trade is going against you, the loss is already larger than it should be. Then your brain switches to loss aversion. You don't want to take the loss because it feels like failure. So you hold. You wait for it to come back. You move your stop. You tell yourself it's just temporary. And the loss grows. This is not weakness. This is biology. Your brain is doing what it evolved to do. Avoid pain. Chase pleasure. But in trading, those instincts destroy you. When you finally do take the loss, when you can't hold anymore, your amygdala floods your system with cortisol. You're stressed. You're scared. And now you need to make back what you lost. But you can't think clearly because your prefrontal cortex is partially offline. You're operating on emotion, not logic. So you either freeze and stop trading, which means you're not making back the loss at all, or you overtrade trying to recover quickly, which creates more losses. Either way, that one bad trade has now derailed weeks or months of your trading, and every day you're not compounding is a day you've lost forever. You can recover the money. You cannot recover the time. Let me show you two traders, Trader A and Trader B. Both start with $100,000. Both have the same strategy. Both target 3% per month, a realistic, sustainable return. Trader A follows his risk rules religiously. He never risks more than 1% per trade. He has a bad month in month 4. He's down 4%, but he stays disciplined. By month 12, he's at $142,000, 42% gain. Solid year. He's compounding. Trader B follows the same strategy for 3 months. He's up 9%. He's at $109,000. Then in month 4, he takes a trade he's very confident in. He risks 10%. He's sure it will work. It doesn't. He loses $10,000. He's back to $98,000. He just erased 3 months of work with one trade. Now he's frustrated. He wants to make it back fast. Over the next 2 months, he takes larger risks trying to recover. He has a few wins, but then another big loss. By month 6, he's at 90,000. He's now down 10%. Trader A is up 18%. Trader B needs to make 22% just to get back to his starting capital. And he needs to make 55% to catch up to where Trader A is. This is the whole. By month 12, Trader A is at 142,000. Calm and compounding. Trader B grinded back to 105,000. He recovered from his drawdown. He's even up 5%, but he lost an entire year. He's $37,000 behind Trader A. Same strategy, same starting capital, one bad trade, one decision to risk too much, and the trajectory of his entire year changed. Now extend that over 3 years. Trader A continues at 3% per month. By year 3, he's at $294,000. He's nearly tripled his account. He's positioned to retire from this in another 5 years if he keeps it up. Trader B recovered in year 1. He was more careful in year 2. He's at $160,000. He's doing fine, but he's $134,000 behind Trader A. That gap is the cost of one bad trade in month 4 of year 1. That's not just money. That's years of compounding he'll never get back. If both traders continue at the same pace, Trader B will never catch up ever, because compounding is exponential. The further ahead you get, the faster you grow, and the further behind you are, the harder it is to close the gap. One bad trade didn't just cost him $10,000. It cost him his entire compounding timeline. Take this into a real scenario. March 2020, COVID crashes the market. If you were over-leveraged, if you had one massive position that you thought was safe, you got destroyed. The S&P dropped 34% in weeks. Traders who were all in on a single leveraged position lost everything, not because they were bad traders, but because they didn't protect against tail risk. One event, one trade sized wrong, account gone. Now compare that to traders who had small diversified positions. They took losses. Everyone took losses, but their losses were manageable. 10%, 15%, 20% at most. Painful but survivable. By June, they were recovering. By the end of the year, many of them were profitable. The over-leveraged traders were done, completely out. Same event, different structure. One group lost years, the other group lost weeks. This is what professionals obsess over. Risk of ruin, the probability that a single trade or a single event could destroy everything. Hedge funds don't optimize for maximum return. They optimize for minimum risk of catastrophic loss, because they know that one bad trade can erase years of gains. Renaissance Technologies, Bridgewater, all the major institutional players, they manage risk first and return second. They size positions so that no single trade, no single market event can take them out of the game. Retail traders do the opposite. They optimize for return and treat risk as an afterthought. And that's why retail traders blow up and professionals compound for decades. Here's what most people don't understand. The opportunity cost of a large loss is more expensive than the loss itself. Let's say you lose 50% of your account. You spend 2 years recovering. During those 2 years, the market is moving. Opportunities are passing. Other traders are compounding. You're stuck at zero progress. If you had just avoided that one large loss, if you had kept your risk tight, you'd be 2 years ahead. You'd have twice the capital. You'd have twice the position size capacity. You'd be earning more per trade because your account is larger. That's gone now. You can't get it back. You didn't just lose money. You lost your position in the compounding curve. And that position is worth more than the dollar amount you lost. So here's the shift you need to make. One bad trade is not just a mistake. It's not just a loss you recover from. It's a permanent setback in your timeline. It removes years from your compounding window. It puts you behind traders who manage their risk better. And the only way to avoid this is to structure your trading so that one bad trade is impossible. You need position sizing that makes catastrophic loss mathematically impossible. You need stops that you don't move. You need rules that protect you from yourself when you're feeling confident or desperate, because your brain will lie to you. It will tell you this trade is different. This one is safe. This one deserves more size. And if you listen, you'll lose years. A large loss is not a setback. It's a career ender for most traders. Some of them quit immediately. Some of them spend years trying to recover and quit later. Either way, they're done. Not because they couldn't learn, not because they lacked talent, but because one trade destroyed their compounding timeline, and they never caught back up. The traders who last, who build real wealth, who actually make it, are not the ones who avoid all losses. They're the ones who avoid catastrophic losses. They lose small, they lose often, but they never lose so much that it costs them years. And over a lifetime, that's the entire difference between success and failure. One bad trade doesn't just set you back, it ends you. Unless you built a system where one bad trade is structurally impossible. And that system is called risk control.